We got to talk about the markets. And in particular, I want to focus on fixed income because we are seeing the 10-year yield creep up ever so slightly, but I guess it's notable in the context of what we have seen. It's getting closer to 1.2%. Michael Kushma is with us here to talk about this. He's Morgan Stanley Investment Management CIO of Global Fixed Income. Michael, it's great to see you as always. 1.2%, I mean, is this significant that we are seeing yields start to climb here? This is certainly something that some market participants had warned against that would have a ripple effect into the equity market, and also as a sign that even though inflation isn't here, market participants see it coming.
That's a good point. The market has become more optimistic about where inflation will be, at least over the remainder of this year, and maybe into the future as well, as the reopening of the economy is continually upgraded in terms of the probability because of the vaccine rollout and the high amount of savings which exist in the U.S. economy and the amount of stimulus which is being provided to the U.S. economy. So it's a combination of all these factors is driving yields higher. But it's important to understand the sources of that rise in yields. It's about optimism about the future. It's not being driven by the Fed's desire to slow the economy down, which would be quite negative, both for fixed income and for equities and other risky assets.
You know, Michael, we heard from Jay Powell earlier this week, kind of reiterating the message that he has been for months now. When you look out to the rest of this year and some of the potential economic developments we could be looking at, how difficult do you think it's going to be for Powell to kind of hold this line, hold his nerve, as it were, on this dovishness that he's really started to exhibit in the last couple of months?
Well, it will be hard because we're going to see most likely very strong growth in the second and third quarters of this year. We will see inflation rising in the next couple of months because of special one-off effects. And Chairman Powell's been quite clear about differentiating between transitory inflation, transient inflation, and troubling inflation. And right now, he has confidence, the Fed has confidence that's transient. It's not long lasting. And because the output gap is large, the unemployment rate is still high, and therefore there is still disinflationary forces longer term at work, which will not allow this rise in inflation to become troubling down the road. So from his perspective, I think it's fairly easy to hold the line now. But as inflation rates actually rise, we have growth potentially in double-digit annualized rates in Q2, Q3. The pressure will be on to hold the line.
So, Michael, given all of that, given that it sounds like we're going to see similar path here for what we have seen in terms of growth accelerating, maybe bond yields going up, but only to a certain level. Are you tweaking your strategy at all at this point, or are you waiting until we get a little further along in the cycle?
Asset prices and fixing them have moved a lot in the past 12 months. Like equities are higher than they were pre-pandemic. Credit spreads have returned to levels they were pre-pandemic as well. In some cases, lower than they were pre-pandemic. So a lot of the fixed income market has also priced in the full recovery in the U.S. economy going forward. So we do think that the valuations are not cheap or inexpensive, but given the overwhelming power of the macroeconomic impulse the U.S. economy seems to have right now, and the extra kick it's going to get from fiscal policy in the next 12 months, it's hard not to see corporations performing even better down the road, which upgrades our views with regard to the performance of high yield assets, corporate assets in general in the fixed income universe. But we are a bit cautious on interest rates. Interest rates are still lower than they were prior to the pandemic, obviously on the short end of the yield curve because the Fed cut rates so dramatically in the springtime and late winter, early spring. But longer term yields are still lower than they were pre-pandemic. And we think they're going back to the levels they were pre-pandemic, just on the basis of the economy doing much better. But they shouldn't rise dramatically because the Fed is in no hurry and no rush to tighten financial conditions by changing either quantitative easing or the level of short-term rates.
You know, Michael, as you mentioned, there's been huge moves within the fixed income market, just as there have been really across financial markets over the last couple of months. But, you know, a lot of the excitement is just all the nuttiness happening in equities, happening in the crypto space. So I'm just curious in your conversations how clients are approaching that when they're talking to their fixed income guy about where that fits into their portfolio.
They have not yet, but there's no doubt that a lot of this rise in asset prices across everything, whether it's house prices, cryptocurrencies, equities, high yield bonds in the last 6 months, there's a flood of liquidity. There's a flood of wealth being created in the equity market rising, housing prices rise, transfer payments, higher income individuals doing just fine through the pandemic. All these things are raising confidence, and people are looking for something to do with their money. And it may be even exacerbated by people being at home and can't go on vacation, so they invest in the equity market instead of going on vacation.
Yes, and they play games, I guess. We've talked about the video gamification a little bit of equities as kind of entertainment for people at home. Michael, thank you so much for being here. Appreciate it. Michael Kushma, Morgan Stanley Investment Management CIO of Global Fixed Income.